All right, let's talk about the cash cycle. Georgina is going crazy. Her company's cash balances just aren't tying out. She thinks that her employees are stealing from her. I guess it doesn't help that she has some shady folks working at her store. Let's meet Mr. Kite. Mr. Kite is a huge Leonardo DiCaprio fan and has been inspired by his movie, Catch Me If You Can. Mr. Kite has been floating checks between various bank accounts. How it works is Mr. Kite writes a check for $4,500 from his bank to his boy Don at Bank A, and then Don writes a check to his guy Larry at Bank B, where finally Larry writes a check from his account for the same amount back to Mr. Kite. Now let's meet Tom Lapp. Tom Lapp works in the bookkeeping and cash department at Georgina's store. Tom receives cash periodically and sometimes pockets it while simultaneously booking that cash amount as cash received in Georgina's books. Wow, Tom, not cool, man. Let's dig into the differences between these two frauds, as well as discuss the substantive tests that we as auditors need to perform in order to get to the bottom of this. All right, so we talked previously about internal controls related to the cash cycle. So let's talk a little bit more about the substantive tests related to this cycle. Okay, so we have a particular interest in the cash cycle as auditors because the cash line item is always going to have a higher risk of being misstated. Not to mention that if management doesn't have a strong system of internal controls, cash can be easily stolen or misstated. Okay, and when it comes to fraud risk related to the cash cycle, there's going to be two types of frauds related to cash that you should know for this exam, all right? You got to know and be able to identify both kiting and lapping. So let's first talk about lapping. So basically how lapping works, and I want you guys to think about Tom Lapp here. A customer is going to pay you cash, right? So what you're doing is you're pocketing the cash, and then when another customer pays you, you're going to book the cash from the first customer with the second customer payment, okay? So you're basically offsetting it, all right? This is total fraud, super illegal. You definitely can't do this. So this is something that is generally just going to be conducted in perpetuity, all right, since newer payments are constantly going to be paid for older debts. So this is generally going to be susceptible when you see one person taking care of all the cash, right, handling all the cash as well as recording all that cash, all right? So think about Tom Lapp here. If he's in control of both cash handling as well as the bookkeeping, he's going to be a high risk of something like lapping, okay? So what are we looking for a company to have strong systems of internal controls set in place for something like lapping? Well, they can have someone other than the cashier send statements to the customer. So generally, customers are going to know what it is that they paid to that company, so they should be able to detect any sort of unusual payments that are going to be made from their account. Stamps can also be put on all the checks. You could say something like for deposit only, right? So this means that the employee can't deposit the checks in their own accounts. And generally, the safest control to set forth is going to simply just have a lockbox, right? So you can have your customers pay directly into a lockbox so that they cannot be intercepted or stolen by those employees. As auditors, how are we going to detect something like lapping? Well, we could detect it by conducting a periodic review of cash receipt records and trace payments to any sort of outstanding receivables. All right, so this is lapping. Let's now talk about kiting. All right, so let's go back to Mr. Kite now. Okay, so when we are looking at kiting, you might be asked a question based on this bank transfer schedule to determine which transactions reflect check kiting. So let's take a look at this bank transfer schedule and better understand which most likely looks like an example of kiting. Now, the question we want to ask ourselves is, when were these transactions recorded in management's books? So we can use a bank transfer schedule to try to sniff this stuff out. Okay, so taking a look at this bank transfer schedule, we see all of these transactions. So if we see here that this cash disbursement was made on December 3rd of year 2, but it was received and it was recorded on December 30th, okay, so if it was received on December 30th, it should have been booked as of that day. Okay, so there's no way that the receipt of the cash should have been an earlier date than the day that it was recorded as disbursed, okay? So this should be done in the same accounting period. Don't look at when it was paid or received by the bank, okay, because that doesn't matter. The bank system can have its own system. Doesn't mean that we are the ones committing fraud here, or that management's employees are committing fraud in this case. It's the bank's fault for messing up the dates. But if it looks messy on the books, then it's generally going to be management's fault. And that can be an indication of kiting. All right, let's talk about substantive tests related to cash. This one is easy. I need you guys to remember bank confirmations and bank reconciliations. We keep our cash at the bank. We are going to look at the bank documents when testing for cash. All right, so we're going to kill 3 birds with 1 stone here. So we can knock out our test of completeness, valuation and allocation, as well as existence by submitting a bank confirmation, as well as by performing these bank reconciliations. So think of our bank confirmations as the same concept as to what we talked about with our account receivable confirmations, all right? We were sending out those AR confirmations to third parties to confirm whether or not the amount that was said to be owed was in fact the amount that was owed to the client. Well, same thing goes for our bank confirmations, only now we are attempting to confirm that the cash balances that are reflected on the balance sheet are in fact the amounts that they have on hand at the bank. For those of you who studied for FAR with us, a bank reconciliation is going to be the same concept as what we covered in our cash section of the FAR exam. We're going to be reconciling management's book balances with their bank statements, okay? So we can do this by footing the bank reconciliation with outstanding checks, and we can agree the balance per books with the balance per the bank statements, all right? So typically we are going to want to test this at year end. Just going to make it a little bit more accurate, okay? So some additional tests to test for our cash transaction assertions, okay? So we talked about the cash balance for our balance sheet cash items, but let's test for the assertion related to the transactions taking place. So our cash receipts and our cash disbursement tests. Completeness. When I say completeness, you say what? Tracing. We're tracing from our source documents to our financial reports. What's the source doc? What's the financial report related to cash? Source doc, this is going to be a sample of remittance advices, all right? And we're going to be tracing those to cash receipts journals as well as our deposit slips, all right? Another one they love to test is tracing from canceled checks to the cash disbursement journal. Our cutoff test related to cash. We're comparing cash receipts and cash payments right before and right after the period under audit. Okay, so we want to make sure that the cash receipt and the cash payment is made in the period that it was actually paid and received. Valuation, allocation, and accuracy. Okay, so here we are going to be footing. We're going to be testing for those numbers to make sure the valuation and accuracy is correct related to cash transactions. So we're going to foot the remittance advices and entries related to the deposit slip, and we're going to make sure that those numbers are correct by comparing them to the cash receipts journal as well as the bank statements. Okay, so our cash disbursements, we remember talking about this in the expenditure cycle. These were involving voucher packages. So what we're doing here related to expenditures, we're going to take a sample from our voucher package and we're going to agree those to the purchase order, the invoice, and the receiving report, all right? The purchase orders and the invoices and the receiving reports all have to do with expenditures. That's why this is related to cash disbursements, not cash receipts. All right, existence and occurrence. Regarding that existence, we're going to be talking about vouching. When we're talking about vouching, we're vouching backwards, all right? So this means we're going from our financial reports to our source documents. What are our financial reports and what are our source documents related to cash transactions? So we're going to vouch a sample of entries from our cash receipts journal, all right? Those are going to be our financial reports, and we're vouching those to our voucher packages as well as to our bank statements, all right? Because those are going to be our source documents. We could find our information related to cash in our voucher packages and bank statements when we're talking about the amount we spent. Okay, so presentation disclosure related to cash. All right, let's quickly run through our assertions related to presentation and disclosure. Regarding completeness, all we're doing here is we are going to make sure that all of the required disclosures about cash are included in the notes to the financial statements, right? So this could be stuff like restricting cash. Does the company have any regulations that define cash as well as cash equivalents, okay? So that's completeness. Valuation, allocation, accuracy, we're going to simply read the footnotes here. All we're doing is we are going to make sure based on our best knowledge that the valuation is going to correspond to what is actually presented in the financial statements. Rights, obligation, and occurrence. Do we have rights to the cash? So how do we do this? We're going to simply compare disclosures to other evidence that we found throughout the audit to make sure that cash belongs to management. Understandability and classification. What we're doing here is we're just reading disclosures to make sure that they make sense, right? We're going to make sure that they're understandable. So this is cash. Remember, it's important to know kiting. Think about Mr. Kite and how he is passing a series of checks at multiple banks, right? He loves that movie Leonardo DiCaprio's in, Catch Me If You Can. You're floating checks from one bank account to another, all right? So what we're doing here, we're going to be using multiple bank institutions and using accounts that don't have sufficient funds, right? So we're going to sniff this out by doing bank transfer schedules. Remember that bank transfer schedule. Also, don't forget about good old Tom Lapp. Don't forget about how lapping works, right? Tom Lapp works for Georgina's company and has been stealing cash and booking the amount in the company's books and records, right? Substantive tests are pretty straightforward related to cash. Remember the bank rec, remember the bank confirmations, okay? You guys are going to do fine on this.